Welcome back. If you're freelancing, you're now your own boss, and the IRS sees you as a business. That means taxes are your responsibility, and it's easy to overpay if you don't know the rules. The biggest mistake? Not claiming all the business expenses you're entitled to. Everyday costs, software, internet, even part of your rent, can lower your taxable income. It's not about cheating, it's about using the rules to your advantage. In this video, I'll break down the top 10 most overlooked tax write-offs for 1099 freelancers in 2025. Stick around. Some of these could save you thousands. Let's start with the home office deduction. It's a popular topic and for good reason. Many people are now working from home, either full-time or part-time, and this deduction can offer significant tax savings. It's one of the most misunderstood tax breaks, often shrouded in confusion and misconceptions. People worry about audits or think it's too complicated to claim, but understanding the rules can unlock valuable savings. If you use a part of your home exclusively and regularly for business, that's the first key requirement. This means the area is solely dedicated to your work, and you use it consistently for business activities. If you meet those requirements, you qualify. It's that simple. But let's delve deeper into what exclusively and regularly really mean. It can't be your kitchen table where you eat meals and the kids do homework. That's considered a dual-purpose space, and it won't qualify for the deduction. It needs to be a dedicated space, a room, or clearly defined area used only for your business. Think of it as your professional sanctuary within your home. You have two main options for calculating the deduction. You can use the simplified method, which is straightforward and easy to calculate. The simplified method allows you to deduct up to 300 square feet of your home office, times $5 per square foot. This gives you a maximum deduction of $1,500. Or you can use the actual expense method, which is more complex but can potentially yield a larger deduction, especially if you have significant home-related expenses. With the actual expense method, you can deduct a percentage of your rent or mortgage interest. You can also deduct a percentage of your utilities, such as electricity, gas, and water. Don't forget insurance and more, including repairs and depreciation. All of these deductions are based on your office's share of your home. This is a crucial calculation. For example, if your office is 10% of your home's total square footage, that's the percentage you'll use. You can deduct 10% of those expenses, meaning 10% of your rent, utilities, insurance, and other eligible costs. The key to successfully claiming the home office deduction is to keep meticulous records. This is non-negotiable. The IRS requires thorough documentation. Save all your receipts, bills, and calculations. Organize them in a way that makes sense to you, whether it's by month, expense category, or another system. Don't fear this deduction. It's a legitimate tax break designed to help self-employed individuals and business owners who work from home. Just document everything meticulously, and you'll be well prepared to claim it confidently. If you're in a high-cost area, where rent and utilities are significantly higher, the actual expense method can potentially save you even more money compared to the simplified method. Take the time to calculate your deduction using both methods and choose the one that gives you the biggest benefit and the most tax savings. Remember, the IRS created this deduction for a reason: to acknowledge the legitimate expenses incurred by those who operate businesses from their homes. So use it if you qualify, and don't let fear or confusion prevent you from taking advantage of this valuable tax break. Don't leave money on the table. Every dollar saved is a dollar earned. Let's move on to another big one, another deduction that can significantly impact your tax liability. Your internet and phone are essential business tools for running your business, connecting with clients, and managing day-to-day operations. They're the backbone of communication in today's digital world, enabling you to stay connected and responsive. They're not just personal utilities for browsing social media or streaming entertainment. It's important to recognize the distinction between personal and business use when it comes to tax deductions. You can't usually deduct 100% of your internet and phone expenses unless you have a dedicated business line. The IRS typically requires a fair allocation between personal and business use, but you can deduct the business use portion of these expenses. This can lead to significant tax savings over time. Estimate what percentage of your usage is specifically for work-related activities. Consider the time spent on business calls, emails, and online research. Be honest and consistent in your estimation. Accuracy is key to avoiding issues with the IRS. For example, if you determine that 60% of your phone and internet use is directly related to business operations, then you can deduct 60% of those bills as a business expense. This applies to the total amount of your monthly bills. It's crucial to keep copies of all your phone and internet bills. Also, include a note explaining your calculation method and the reasoning behind your business use percentage. This documentation will be invaluable if you ever need to justify your deductions. Over the course of a year, these deductions can add up to real savings, significantly reducing your overall tax burden. However, don't claim the full amount of your bill unless you have separate business lines dedicated solely to your business activities. Remember, thorough documentation is absolutely key to substantiating your business expenses. This is especially important if you're ever asked to justify your deduction during an audit or review. Make it a habit to track your usage regularly, noting the time spent on business-related calls and online activities, and be sure to save all your receipts, either physically or digitally, for easy access when preparing your taxes. Every dollar counts when it comes to reducing your tax liability and maximizing your business profits. Health insurance is a huge expense for freelancers, but your premiums are deductible. This is an above-the-line deduction, so you don't need to itemize. You must have a net profit and not be eligible for an employer or spouse's plan. Deduct premiums for yourself, your spouse, and dependents under 27. Medical, dental, and long-term care insurance all count. Keep records of every payment, bank statements, or insurer confirmations. Report this on Schedule 1 of your 1040. This deduction can make a big difference in your taxable income. Don't miss out. Track your premiums all year. It's one of the most valuable deductions for freelancers. One of the biggest differences between being a freelancer and a traditional employee is the absence of employer-sponsored retirement plans. Freelancers don't get a company 401k. That automatic enrollment and matching contribution just isn't there. It's easy to feel like you're missing out. But don't despair. You can still save for retirement, build a secure financial future, and cut your tax bill in the process. In fact, the government offers some pretty sweet deals to encourage self-employed individuals to save. SEP IRAs, or Simplified Employee Pension Plans, and Solo 401 KAs are your best options for doing just that. They offer flexibility and significant tax advantages. With a SEP IRA, you can contribute up to 25% of your net self-employment income each year. This means that a quarter of your earnings can go directly into your retirement savings, up to the IRS limit. The IRS sets an annual limit on how much you can contribute, so be sure to check the current year's guidelines. Solo 401 Ks offer even more flexibility. They let you contribute as both employee and employer, essentially doubling your contribution potential for even higher limits. The beauty of these plans is that contributions are tax-deductible, reducing your taxable income in the present, and your investments grow tax-deferred, meaning you won't pay taxes on the earnings until retirement. Let's put that into perspective. If you contribute $20,000 to a SEP IRA or Solo 401k, and you're in the 24% tax bracket, that's $4,800 in tax savings right now. SEP IRAs offer an added bonus. They can be set up and funded all the way up to the tax deadline in April of the following year. However, Solo 401 Ks must be established by year-end, December 31st, to be eligible for that tax year. Even if it's late in the year, you can still act and take advantage of these retirement savings options. So, take the initiative to invest in your future and simultaneously lower your taxes now. It's a win-win situation. Don't skip this powerful strategy. It's one of the smartest moves you can make for your long-term financial well-being. Business meals are deductible, but only if you follow the rules. The meal must involve a real business discussion with a client, partner, or advisor. You can only deduct 50% of the cost: food, drinks, tax, and tip. Keep every receipt and note who you met and what you discussed. Lavish meals aren't allowed, but reasonable ones are fine. Some exceptions allow 100% deduction, but for most freelancers, stick to 50%. Documentation is everything. No receipt, no deduction. Be smart and keep your records organized. Invest in your skills and write it off. Courses, books, industry subscriptions, and conferences that improve your current freelance skills are 100% deductible. Travel, lodging, and 50% of meals for conferences also count. The education must relate to your current business, not a new career. Keep receipts and note how each expense helps your business. Professional development is a smart investment and a tax break. Track every expense, big or small. Grow your business and save on taxes at the same time. Software and online tools are the backbone of your freelance business. accounting apps, design suites, project management tools, website hosting, email marketing, and cloud storage, all deductible. Go through your bank or credit card statements and list every subscription. Even small monthly charges add up to big annual deductions. Categorize these as software or subscriptions in your records. Keep invoices or payment confirmations. These are some of the easiest deductions to justify. Don't overlook your digital expenses. If you drive for business, client meetings, post office runs, supply trips, you can deduct those miles. Use the standard mileage rate, 67 cents per mile in 2024, or the actual expense method. Standard rate is simple. Log your business miles, multiply by the rate. Actual expense track all car costs, then deduct the business use percentage. Keep a detailed mileage log. Date, destination, purpose, odometer readings. Apps like MileIQ make this easy. You can also deduct parking and tolls. Choose the method that gives you the bigger deduction. No log, no deduction. So track every trip. Vehicle expenses can add up fast. Don't miss this one. Marketing is essential and fully deductible. Paid ads, social media promotions, website costs, logo design, business cards, and flyers all count. Content marketing, email newsletters, professional photos, and networking memberships are included too. Keep every invoice and receipt. Make sure each expense clearly relates to promoting your business. This is one of the most straightforward deduction categories. Invest in your growth and write off every penny. Good records mean bigger tax savings. Don't let marketing expenses slip by. Bank fees and payment processing fees are easy to overlook, but they're fully deductible. Monthly bank account fees, wire transfers, and check orders all count. Payment platforms like PayPal, Stripe, and Upwork take a cut. Deduct those fees. Always record your gross income, then list the processing fee as a separate expense. Download annual transaction reports to track these costs. Over a year, these fees can add up to thousands. Don't pay tax on money you never received. Track every fee and maximize your deductions. Those are 10 of the most overlooked tax write-offs for freelancers. Track every expense. Start now with a spreadsheet or accounting app. Consult a qualified CPA for personalized advice. The tax code is complex and a good advisor can save you thousands. What write-offs have helped your business? Share in the comments. If this video helped, hit like and subscribe for more freelancer tips. Thanks for watching. See you next time.